investment assets, and what's the rationale behind the recent issuances?
Thank you, Winston, and good morning to all your listeners, and I believe your viewers on Facebook as well. So, before I get into a direct response to the question, let me start by restating or re-emphasizing the mission of the SEC, because that for me represents the basis on which we take any action. So this directive that we have given and any other thing that we do is based on why we exist. That's our mission, which is to regulate, innovate, and promote the growth and development of an efficient, fair, and transparent securities market in which investors and the integrity of the market are protected. So everything we do, we are looking at how do we protect investors, how do we protect the integrity of the market, how do we ensure a fair, efficient, and transparent market so that it's clear no one has one advantage or the other over the other. So that is a premise, our mission statement. Now, again, if you permit me, Winston, let me try and break things down a little bit.
Please
just
do.
so that we can get a better grasp of the issues. When it comes to investment, when you invest in a collective investment scheme, and a collective investment scheme is a scheme where a number of investors pool their monies or their savings together, they give it to a licensed fund manager who would invest the money in different investment instruments. Okay, so whether they are buying shares that are listed on the stock exchange or they buy fixed income instruments. Okay, so that is what a collective investment fund would do, to buy different instruments. Now, when they buy, whatever securities they buy, whatever investment instruments they buy at a certain price. Okay, so if, for instance, a fund manager has what we call an equity fund, which means that the fund is invested in shares, equity shares that are listed on the stock exchange, for instance. It means that they'll be buying, let's say, Ghana Commercial Bank, EcoBank, Enterprise Group, etc. They'll buy it at different prices. Now, when it comes to investment, it's important to understand that there's a difference between price and value, and I'll explain.
Please do.
Okay, so I know that, for instance, Black Friday is coming, isn't it?
Sure.
And typically you find people will reduce prices. So let's say there's a 65-inch television you've been aiming to buy. The current price, let's say, is 12,000 Ghana cedis. But on Black Friday, the price is reduced to, let's say, 7,000, because of what is being offered. Okay. Now, when you buy that 65-inch television at 7,000, the value of the TV doesn't change. If it's a color television, if it's a smart television, it will still work. It's the price that has changed. Okay. So price and value are two different things. Okay, so you find that in investing, we say that you pay the price and you get the value. And that's why, for instance, you'll be told that if you are buying, let's say, equities, you want to shop for equities that are undervalued. In other words, the market price is different from the value, with the hope that with time, the market price will approach or even exceed the value. And also that's why when you think that a stock or an equity is overpriced, in other words, you think that the market price is higher than its value, you typically would sell, to make some gain, because you know that ultimately the price will approach the value. I'm saying this because we need to understand that there are a number of things that would impact the price of a particular security. So if it's shares, it can be things like the company makes an announcement about dividends, or it has announced a breakthrough in terms of market, a new market or a new product or change of MD. A number of things would impact the price of the equity, because people would respond, hey, if this has happened, then maybe we're going to get a lot of dividends. So demand and supply would work on the price. Now, when it comes to fixed income, bonds, there are also a number of things that impact on the price. One of the key determinants of the price of a bond is the level of interest rates in the economy. And indeed, the relationship between interest rates and the price of bonds is inverse. Inverse means that they move in opposite directions. So when interest rates go up, you find that bond prices will go down. And when interest rates also go down, bond prices go up. Okay, so that is one principle, and that's how it works.
Okay.
So if you take a collective investment scheme that, for instance, has bought fixed income like bonds, and you have a situation where interest rates go up, if you have to sell the bonds that in the portfolio today, you will not be able to sell it at the face value. You sell it at the market value, the market price, the price at which the market is valuing. Okay. Now, we also understand that when it comes to bonds that are listed and trade, bonds have a tenor. It can be 2 years, it can be 5 years, it can be 7 years, it can be 20 years. Now, within the tenor of the bond price can actually move up and down depending on how interest rates are behaving. Okay, so but on maturity, the bond reverts to its face value. That's 100% of the face value. But between or during the tenor, the price can go up and down. And like I said, it's the relationship with interest rates is inverse. Okay, so what it means that if you have a portfolio that you have bonds, and you are in a period where interest rates have gone high, and you are under pressure to sell the bonds to meet liquidity or redemptions or from your investors, what will typically happen is that you go to the market and you sell at the market value. So if interest rates have gone up and you have to sell your bonds today, in all probability, you sell it at a lower price. Okay. When interest rates have gone up and you go out to the market to sell your bond, you sell. Interest rates have gone down and you sell the bond at a higher price because of that inverse relationship. Now, why did we come up with this directive? So we have a situation where, given the challenges in the macroeconomic environment, inflation has gone very high. We all know that. The cedi is under pressure. We all know that. So interest rates have gone up. Okay, so the idea here, when we talk about mark to market, is to let the fund managers give the investors in the fund an idea of the current market value of their investments. In other words, you want to tell the investors that, well, because of where interest rates are, the value of the investment is so much. If I have to sell the investments today, that's the bonds today, to pay you, I will have to sell at the prevailing market price, not at the face value, because that's how it works.
Okay.
So the essence of the directive is to get the fund managers to reflect what is the current or true market value of the investments in their portfolio, the fixed income portfolio. Now, Winston, let me quickly say that for those who have been managing equity funds, that's funds that are invested in shares, they already mark to market, because at the end of the day, they'll get the prices of the shares they've invested in on the stock exchange, and they use it to value the portfolio. They will not use the price at which they bought the share. So, for instance, if they bought the share at 1 cedi, and today the price is 1.5, or today the price is 80%, they'll use the current price, to value the equity portfolio. So I'm saying mark to market already is being done, okay, by the equity when it comes to equity portfolios. However, a number of the fund managers have been using what we call hold to maturity approach when it comes to the fixed income, where they buy the bonds, and the strategy is to hold to maturity. So they rely on coupons that will come in to either reinvest and so on and so forth. But what we are trying to achieve here is that we want the fund managers to reflect for especially the fixed income portfolios. Already, equity portfolios are marking to market. So for the fixed income portfolios, for them to let the investors appreciate.
Yeah, but the question is, so with the equity one, it's already being done. Why did it have to take SEC to direct the fund managers to do this?
Okay, so I'll answer it in two ways. Number one, actually, there are some fund managers that are already marking to market, okay? Because before we came out with the directive, we did a survey just to confirm those who are and those who are not. So some are already doing that. And like I said, there were some fund managers whose strategy, and indeed, IFRS 9 would, if you look at it, will give you the idea that based on your business model, make sure your valuation method is consistent. Okay, so where your business model says you hold to maturity and then you reinvest the proceeds in other instruments, you would tend to do that. So a number of them were doing the hold to maturity, or using the hold to maturity approach to value their fixed income portfolios. But the difficulty or the challenge with that is in an environment where interest rates have gone up and you are not showing the investors what the real market value is currently. If they have to exit, then they will have to exit at an elevated level, because the market value is, let's say here at 0.5, for instance. That's the market value, but the face value, or if you're using the hold to maturity, is high. But if the fund managers must go to the market to sell the securities today, they can't sell at the face value. See? So we are saying that it's important for you to let the investors see that if I have to sell today, then this will be the value. And this is important because there's also the concept or the principle of unrealized gain and unrealized loss.
What's that?
Let me explain. So when you, let me start with equities to make it clear. If you buy, let's say, shares of enterprise, and you bought it at, let's say, 1 cedi, and you bought it 3 years ago or 2 years ago, and today the price has moved to 2 cedis. And please, I'm just using the figures. Those are not the real prices. The difference between the price at which you bought it, which is 1 cedi, and the current price, 2 cedi, that's what we call a gain, a capital gain. But when you don't sell your shares, the gain is unrealized. So the gain is on paper. Okay. In the same breath, if you bought the shares at 2 cedis, and the price, you bought it last year or 2 years ago, and the price has dropped to 1 cedi, on paper, you have lost 50%, right? Okay. But it's unrealized until you sell. So if you don't sell, excuse me, if you don't sell your, sorry, my throat is a bit, okay. If you don't sell the investment today, you don't realize the gain or the loss. Okay. So that's an important principle because security prices move, within the period of time you be holding it and based on various market sentiments. But when you sell or when you check out, then you lock in either the gain or the loss. Okay. So the fact that I show you your mark-to-market value today, and it's dropped beyond what maybe you saw some period back, it doesn't mean that loss has been realized. But you realize that loss, or you lock in that loss when you say, I don't want this anymore. I want to sell. So once you sell, you have to sell or exit at the prevailing market price. Okay. So if we understand that there is this concept of unrealized gain and unrealized loss, when you see a drop in the value of your investment in the collective investment scheme because the fund manager is marking to market, you don't realize that loss until you check out.
Okay.
So that is important.
I'll get back to you shortly. This morning we're joined by Reverend Daniel Ogbami Tete, who's Director General of the Securities and Exchange Commission, and Mr. Kise Antonio, who's Vice President of the Ghana Securities Industry Association and Managing Director of Sentinel Asset Management. But for the general public, there's a certain fear. They have had conversations about a possible debt restructuring, and particularly a haircut. And they ask themselves the simple question: how different is what they're experiencing now from the much feared haircut?
And my answer is totally different. There are two different things. You know, and let me say that I think there's a lot of speculation as to what government would do or what government would agree with the IMF regarding its debt to ensure sustainability. We don't have the details, but there's a lot of speculation in the system, you know, about haircut. But when we talk about mark to market, it has nothing to do with a haircut. We are just saying that it's a valuation approach or methodology that we want the fund managers to use to indicate to the investing public that this is looking at the current market price of the securities we have invested in. This is what the value would be. Okay, and it's not about haircut at all. And like I explained just before you asked this question, there's a concept of unrealized gain and unrealized loss. Okay, when it comes to investment, when there is a decline in your investment and you sell or you exit, then you lock in that loss. But because of the fact that market prices can move up and down, over time, it's possible for whatever decline you would have seen, you know, to be erased. And I can cite so many examples of, you know, people investing. Some when they saw a drop, they panicked, they exited, they locked in the loss. Some understood, didn't exit, didn't check out. And then when there was a recovery, when the market repriced assets, you know, they were the ones laughing all the way to the bank. You know, so this is not a haircut conversation at all. Mm-hmm. We are saying that it's a valuation approach. And let me say that the valuation approach, whether it's hold to maturity or mark to market, it doesn't really affect the underlying value of the securities that you have bought. It's just saying that how are you reflecting its current value? And like I said, you know, price and value are always, you know, are not necessarily the same. Of course, investment professional will tell you that, especially equities, the price is expected to approach the value over time. And I've also explained that with bond prices on maturity, you find that the price will revert to the face value. So I think it's important to be very clear that this is not a haircut conversation. We are saying that it's important we let the fund managers show to the investing public, those who have invested in the collective investment schemes, that based on market prices, this is what the value of the investment is. It's not about a haircut at all.
So, Reverend, SEC has intervened, right? You've first of all issued a directive to the relevant institutions. You've published that directive on your website. You've issued a press statement to the public, informing them that you've issued this directive. You've even released a list of frequently asked questions. My question is, if what you're describing is a matter of course, if that is what ought to be happening anyway, why was there a need for SEC to issue a directive? Was this not happening automatically?
Yes, so I think I explained earlier that before we issued the directive, we did a survey to confirm the number of market operators or fund managers, for that matter, who were doing using the mark to market, and those who were using the hold to maturity for their fixed income portfolios. And the results indicated that majority were using hold to maturity. Some were using the mark to market. Now, if you look in our LI 1695, it makes reference to using you know, the market price, you know, to compute the NAV. and so being aware that if the
When you say
sorry,
what do you mean?
I apologize. That's the net asset value of a collective investment scheme, which is
Right.
effectively the price. Okay, so we had to come in because if the fund managers continue to use the hold to maturity, approach with the fixed income portfolios against the background of a lot of people wanting to exit, given the current economic challenges and people not being sure what would happen. If they are not marking to market, people will be exiting at values higher than the real, the current value. Okay, so we had to, come in to say that you need to mark to market, one, so that investors would see clearly that this is the value that I would get if I exit at this time.
But was it an option? Did fund managers have the choice of either marking to market or not?
So again, earlier I indicated that if you look at IFRS 9, which everyone we have subscribed and they are all supposed to work with, it gives you, if you like, I don't want to say the leeway, but it indicates that based on your business model. So if you even look at the directive that we issued, we indicated that for fund managers whose business model will constrain them from using mark to market, they can write to us. And I can give you an example. So for instance, money market funds, and maybe let me explain a little bit. Fixed income refers to the broad spectrum, whether it's short term or long term. But money market typically is a year and below. You can have a collective investment scheme that is a money market fund. You can have a collective investment scheme that's a fixed income fund. A money market fund, for instance, would invest in the short end, 1 year and below. And you find that for money market funds, mark to market really is it doesn't make a difference. So they may use the hold to maturity. So that's why I'm saying that we indicated in the directive, if you look at, I think 5.3, we did say that if you are constrained by your business model, to comply, you need to write to the SEC and explain why you cannot.
Right.
So that really is what it is.
So does this mean there are customers who may have signed up to some facility that is a hold to maturity fund, but now, because of your directive, are going to be subject to mark to market? Are there customers who are going to get something other than what they signed up for?
So let me answer it this way. If you have invested in a fixed income fund that previously they were using the hold to maturity approach to value the investments, and remember, I'm like I said, is the method they're using to value. As for the underlying investment, the valuation method doesn't impact it. Okay, so the underlying investments is what you signed for. The question is, if you are exiting, at what price do you exit? Mark to market simply says that, and that's the rational thing, to do. You exit at the prevailing market price. So if you signed into a fixed income fund and they are marking to market and you are exiting today, you will exit at a value that is consistent with the prevailing market price of bonds. I mean, that is what it is.
And the next question would be, so will the valuation also show you the value if you hold the investment to maturity, to be able to help the holder make a decision on when to hold or cash out?
Very good question. And actually, the mark-to-market valuation approach is good in the sense that it helps the investor to know when to go in and when to go out. Now, the fund managers can show investors that if we are marking to market, this is what the value is. If we are holding to maturity, this is what the value is. Because remember, I said that with bonds on maturity, because bonds have a tenor, shares or equities don't have a tenor. So in terms of the volatility in the price of shares, it can go on and on and on. But when it comes to the fixed income or bonds, on maturity, it reverts to 100% of the face value. So to answer the question directly, the fund managers can show you that if we are holding to maturity, this is what the value would be, and invariably, all things being equal, let me put it that way, the hold to maturity value would be higher than if you are marking to market. But like I said, it's a question of what is the prevailing market conditions. But yes, they can show the hold to maturity value, and indeed, for those who are using the hold to maturity values, you find that what they are showing their clients are at a certain level. Once they apply the mark to market, because of where interest rates are, the values will drop. So definitely they can show the hold to maturity value of the portfolios, that's the collective investment scheme that they have, and they can show the mark to market value. And then the investor will see that, okay, so if I'm exiting today because of prevailing market conditions, the fund manager will have to sell at the market price. It means I will exit at a lower value. But if I stay, if I don't check out, and the fund managers hold to maturity, this is where the valuation would be.
Let me bring in Kisa Antonio, because you've talked about they can. I'm sure what people want to know is, are they doing it? Is that what you're doing? Are you showing us also the valuation if we are to hold on till maturity, so we know that this is what we are getting?
Yeah, I think some of the fund managers who were hitherto using the hold to maturity valuation methodology, they're actually showing them their customers, what the returns are using that methodology, and what the mark-to-market valuation methodology is also bringing up. Like Rev rightly said, we are currently in a high interest rate regime, and that has adversely impacted bond prices. So bond prices are depressed. Okay, and if it's important that we adopt this new valuation methodology so as not to hurt people who will be left behind in a fund when others choose to exit. So let's say if I'm showing you a hold to maturity valuation return of 20%, when the actual market return is 15%, and let's assume it's the three of us in a fund, and you, Winston, are exiting. What will mean is that if you exit using the hold to maturity valuation methodology, you'll be getting a more than proportionate share of your interest in the fund, vis-a-vis the market value. So I think it's important that we've embarked on this journey so that all investors in these collective investment schemes will be treated fairly, and I guess more importantly, equally.
Great.
Okay.
But let me just stay with you,
Yeah.
Mr. Antonio, also, because I need to understand. I mean, you are within the market.
Yeah.
How has this directive from SEC affected you? How do you see it, and how are investors responding to this directive?
No, obviously, because of what we're currently experiencing. I mean, people get emotional about money. Some investors are not taking it well. Others do understand the situation, okay? But like I stated, people need to understand that, look, nobody has taken their money. People will say, hey, you guys have stolen my money. You guys, are you sure it's not a haircut in effect? No. It is just, people are seeing depressed valuations, vis-a-vis what was being earlier communicated to them. But it's important for people to also realize that with fixed income securities, as they get closer to maturity, these asset prices rebound. So this is a time Rev was talking about the concept of unrealized losses and unrealized gains, where these gains and losses are on paper. So I guess it's important for everyone to keep a calm head. Let's not unnecessarily panic, because Look, we things will definitely rebound at a point in time, and when things get better, interest rates start trending downwards. I know that it's hard for people to see that when inflation is over 40%. The prices of these bonds are going to rally. And when that happens, what is currently happening will be the opposite.
Okay.
And you're going to see bond prices trading at a premium to the face value.
Now, I mean, Reverend Obami Tete, the other issue is with even with mutual funds. You've seen them, for instance, telling you, invest with us annually. You're guaranteed, some would advertise you're guaranteed a return of say 18%, 20%. So for the ordinary investor, he knows that he's guaranteed a return. Someone has made a point that maybe you should tell them not to be putting guaranteed returns. Because if I put my money there and I'm expecting guaranteed returns and you tell me you're marking to market, then I have a concern.
Actually, they are not supposed to be guaranteeing returns. So if you can furnish me with a list of the people who have been doing that, we'll go after them. Mutual funds are not supposed to guarantee returns in any shape or form. Indeed, in 2018, the SEC issued a directive to the market because there was a practice where some of the fund managers were receiving monies and guaranteeing the returns to their investors. But that was outside of the mutual funds or the unit trust. And we were clear that that practice is illegal and must cease. So we actually keep, monitoring the space. And if we pick up people who are guaranteeing, we'll allow the law to, have its course. But for mutual funds or unit trusts, they do not. The way you see your investment performing in a mutual fund or unit trust is when you look at the price, what I earlier referred to as the net asset value. And the price will move on a daily basis based on the underlying investment. And that's why if you have a fixed income portfolio and they are marking to market, you see that today, because the bond prices are depressed on account of high interest rates, the value of your investment would have gone down, but it's not really locked in until there's an exit, from the fund.
Mr. Antonio, is this still a good time to invest?
Personally, I think so.
Why?
There's a maxim in investment management. You buy when prices are low and sell when prices are high. When we're talking to market now, we're making reference to fixed income securities. I mean, when you buy equities or shares, as we commonly call them, with shares, there's a lot of fluctuation. When we talk about, prices going up and down, which in finance we refer to as volatility. Okay, with shares, that is finite. With fixed income, volatility. No, with shares, it's infinite. With bonds, it's finite. As bonds, move towards maturity, prices tend to go towards the face value. So when you hold bonds to maturity, you are going to get, or the certainty of getting your principal back is way higher. So for me, I think looking at where prices are now, it might be a good time to invest. I know it's difficult to tell people that invest in a time like this, but if you look through history, you look at all the famous investors in the world. I mean, they always bought when it was high, and look, in times like these, they provide opportunities. Okay, invest in opportunities. So a lot of people are overselling because things look bleak, but in doing that, you keep further depressing prices, which provides good upside potential if you should come in now.
Finally, Reverend Obami, yes.
If I may just add to that, you find that I gave the analogy of Black Friday, right?
Yes.
A lot of people time when there are sales, to do their shopping because the prices are depressed. So it's the same principle. Yeah. During a time when whether equity prices or bond prices are depressed, if you have a long time mindset, then it's important to keep investing. But my last word is that the SEC is committed to protecting our mandate, which is to ensure investor protection and then the protection of the integrity of the securities market, including the various schemes that we license, like the collective investment schemes. And so we'd like to encourage the public to continue to deal with our market operators, and if they have questions, they should, demand good answers. If they are in doubt, they can reach out to the SEC. Our website, www.sec.gov.gh. They can send an email, info@sec.gov.gh. If you go to our website, we have a toll-free number. They can reach out to us where in doubt or where they have complaints, for us to resolve. But it pays to invest, and we have capitalized fund managers that are operating schemes, and SEC is stepping up its supervisory activity. So let's keep investing, and let's not be, if you like, discouraged by the current tough macroeconomic conditions that we are facing as a nation.
Thank you very much, Reverend Daniel Ogbami-Tete, who's Director General of the Securities and Exchange Commission, and Kisa Antonio, who's Vice President of the Ghana Securities Industry Association and Managing Director of Sentinel Asset Management, for joining us. We're very grateful you made time to join us. My producer tells me the conversation will continue on Monday, so see you on Monday. Stay with us. We'll be right back.